Welcome to the first lesson in our series of tutorials on how to create a three-statement projection model for Apple. And what we're going to be doing in this series of tutorials is taking the basic accounting model that we had created before with Apple's three statements for 2008 and 2009, and we're going to be extending this for 5 years into the future. So we're going to be looking at 2010 through 2014 specifically, and I'm going to be showing you how to make the appropriate percentage assumptions and some of the other key variables that we'll have to look at in order to make these projections and see what Apple will look like as a company going forward over the next 5 years. What I want to do in this video is just give you an overview of exactly what's included in the model that you see in front of you right now and how this is different from the other model that we looked at with Apple's three statements in the previous course, the income statement, balance sheet, and cash flow statement. So I want to give you an overview of that and some of the key points to keep in mind. The other thing that I want to do here is also show you how to properly set up Excel to make sure that all your settings are set to the correct values and so that everything works correctly later on. So to do that first, if you go to Alt-TO for options in any version of Excel, and you go to formulas, in Excel 2003 this interface will look a little different, but if you go to formulas right here, what I want you to do is to make sure that workbook calculation here is set to automatic, and also that enable iterative calculation right here is checked. The reason that it's important to have both of these is because later on we're going to be getting into situations where we need to do iterative calculations. In other words, where we have formulas that are circular, where the formula output depends on the formula input. And to get around that situation, to make sure they work correctly, we need to make sure that iterative calculations here are enabled and that workbook calculations here are set to automatic, just so that everything refreshes and updates properly on our Excel sheet. So once you have those two settings set, you can actually close this, go to OK or press Enter, and go back to this Excel worksheet now. And so what I'm going to do here is just go through this entire page that you see in front of you and start from the top and then go to the bottom and go through some of the key points and differences between the model that we saw before. So up here at the top, you see some of our key assumptions: the company name, the year that we're starting at, the historical year of 2009. The reason we have this is to make our model more flexible. If you press F2 here, you see that I'm linking directly to this historical year. So if I change this to, say, 2010, then our model will be flexible enough to support that. The debt issue date and the debt amount, so we're going to be assuming in this model that Apple actually issues debt, mostly to get you thinking about it and to show you the basics of how interest expense works and how it flows through the three statements, but we're going to be incorporating that and pretending that they actually issue debt for some reason in coming years. This days and year variable right here, this is something that we do for accounting purposes, and I'll be getting into this when we look at some of the balance sheet projections and trends, but it's really for accounting purposes to make sure that each month has 30 days and to make sure that each quarter has 90 days and to avoid us having to deal with leap years, for example. So that's why we have that. Now the other assumptions here we'll be dealing with in more detail in future videos, but basically the idea here is that we want to look at some historical percentages, so how much revenue has grown, what our expense profile looks like, and then use those in the next 5 years to figure out what Apple will look like from 2010 through 2014. So moving down here on the income statement, if we just go back and compare it to what we had in the other one, you see that the income statement here looks pretty similar. There are a few differences. The main difference here is that I've split out depreciation and amortization of plants, property, and equipment, amortization of intangibles, and stock-based compensation separately. What I've done here, if you look in some of the formulas for cost of goods sold, for example, research and development, selling, general, and administrative, you see that I'm subtracting a few numbers here. I'm basically taking out the stock-based compensation number and then also the depreciation and amortization numbers here. The reason I'm doing that is because we want to be able to project those separately. Right now, if you look in Apple's filings, you see that they're actually embedded in the other expenses. So we want to remove those to make sure that we're properly projecting these numbers. Also, under interest income expense and other income and expense, I've split these up into all separate items now. I'm doing this mostly for your own purposes to help you better understand what's going on in the model, because later on we're going to be treating interest income and interest expense differently when we make our projections here. So that's pretty much it for the differences on the income statement. On the balance sheet, Again, going back to what we had before, most of these items are very, very similar, especially on the asset side. Current assets pretty much matches exactly, and then long-term assets also pretty much matches exactly. So there's really not too much different on the asset side in the balance sheet. The only difference here is that we're looking at 2008 and 2009, and then in the future we're going to be looking at 5 future years instead of just 2008 and 2009. On the liability side of the balance sheet, again, it's very similar. One item that I've added here is long-term debt. If you recall from the model that we looked at before on the balance sheet, we just had these two items under long-term liability. So I have added in long-term debt here. Shareholders' equity is pretty much the same. Some of the formulas here will be a little different because we'll have some added items here, but the concept here is exactly the same. So not too much here is different. Then we also have this balance check here at the bottom. This is just for our own purposes as we go through and build this model. One thing we want to be careful of is that as we create our balance sheet, it properly balances. In other words, assets equals liabilities plus shareholders' equity. If that's not happening, we have a problem and we want to be able to fix it and notice it as soon as possible. Then on the cash flow statement, there are a few differences here. You see that I've split out depreciation and amortization of PP&E separately from amortization of intangibles. Other than that, stock-based comp, deferred income taxes, and loss on PP&E are all here. Changes in operating assets and liabilities, these are all exactly the same, so nothing much to mention here. Under investing activities, this is exactly the same as what we saw before. And then financing activities, I've added in a couple things here. Common stock repurchase, dividends issued. We didn't have those before because Apple was not repurchasing stock, or they were not breaking it out exactly like this, and they were not issuing dividends. And then I've also added in this item for raising and paying off long-term debt because we're adding that capability to our model right here. So overall, there's not too much that's dramatically different about this model versus what we saw before with the simple 3-statement accounting model that we had for Apple. The main difference really is that we're looking at this over a period of time, over 5 years, or actually even more than that if you take into account the historical years, 2007 through 2009. And so that brings with it some added complexity. We'll have to look at a few different variables there, but that's really the main difference. I've also split out things a little differently and created some separate line items here, but overall, if you've already been through the other model, this one should be no problem for you to get used to. So that's a quick overview of what's in this model and how it's different from what we saw before. Coming up next, we're going to be looking at Apple's income statement, and we'll be seeing a few different ways that we can make projections on the income statement and see what's going to happen 5 years into the future there.